How's it going, crypto community? This is Jade Martian, and I'm back with another part on this series where I am breaking down the entirety of the Swiss National Bank conference, where Brad Garlinghouse, as you can see there on the far right hand side of your screen, is sitting on this panel, and thus he will be our treat at the end where we listen to his response to the Q&As, right? And a little bit from him prior to that. Now, in this panel episode, we're going to be listening largely to Charles Engel. I don't know if we will get through his entire piece because I hope to limit this to about 30 minutes. But we'll see where we get and how I'm feeling by the time we get to the 30-minute mark. Maybe we'll go a little bit more. Anyways, to get right into it, if you're not familiar with my stream, this is one of my in-depth dives. I've done 2 parts prior to this one, where we broke down earlier segments of the panels, as well as another speaker, Barry Eschengreen. And so, in this one, we're going to be obviously breaking down what is being said by Charles Engel. Now, Charles Engel is an American economist and currently the Hester Professor in the Economics Department at the University of Wisconsin-Madison. He is also known for his research in nominal real exchange rate movements. So, he is a teaching professor who all of these extremely powerful individuals is permitting to moderate this panel, right? Now, he has a pretty interesting perspective, and so I feel he's at least worth sharing with you, and let's try and delve right into this, and you'll see why it is. I'll break down for you as we go.
The lead speaker for the panel on...
Apologies. It wouldn't be a Jade Martian video without one, right? You never know when they're going to come in, but they seem to be in every video.
On the IMF in a changing global landscape will be Professor Charles Engel from the University of Wisconsin. Please.
Well, thank you very much, and thanks very much to the International Monetary Fund and the Swiss National Bank for organizing this conference. It's been really productive and informative. So this session's on the future of the international financial system, and we're going to follow the same ground rules as before. That I'll have 15 minutes of introductory comments, and then I've been told to strictly enforce the 10-minute limit on our distinguished panel, but then I haven't been given any enforcement tools, so we'll see how that works. And being an American, I might threaten to impose financial sanctions, but being American, there's nothing, no sanctions can be imposed on me, so we'll see how that goes.
Alright, so let's touch on that real quick, right? This is obviously a global community meeting, not just Americans, even though there are many Americans obviously here. You need to understand that these are also the most powerful people in the world that he's telling this joke to, and the people that are in charge of these trade wars and things that we hear about, right? Listen to how lighthearted this kind of thing is to them. Why? I mean, it is obviously just kind of comical to an extent because of the irony inherent in his words, but it's also comical because it's not taboo to be comical, right? So that's something to keep in mind, the sentiment of the community that's listening, and how they, at first, his first one was, haha, his second one landed, and most people laughed, right? So, anyways, let's hear what else this comedian and also professor has to say.
So it would be presumptuous of us to try to forecast the next 75 years of the international financial system. What we can do is discuss the factors that are currently effecting change in the international financial system. And one of the major factors, of course, is financial technology. So fintech offers the promise of making the international financial system more efficient. It could speed international transactions in finance and facilitate international trade and potentially increase financial inclusiveness. But then it poses challenges for the implementation of monetary policy and certainly for financial regulation, for policies dealing with financial crises, and it brings serious concerns about cybersecurity. Now, a particular set of concerns has arisen over privately issued digital currencies. And again, the questions are whether those digital currencies could actually supplant central bank currencies, but maybe more importantly, how do they affect monetary policy transmission? How do they affect the payment system? How do they affect financial stability? Now, in my limited time, I am...
Now, before he jumps on to his next statement, let's hop into basically what he just said, right? He's outlining basically that he's not wanting to say that this is absolutely going to happen, but it would appear that this is what's happening. And what's happening is the transition to this new space. Now, the space has many pros and cons. He listed, both sides in his 2 slides there. And now we're jumping to, his next focus here. So let's hop into that.
I'm going to just focus on one aspect of these changes, which has gotten a lot of attention at several central banks, which is the possibility of introducing central bank digital currencies. And my remarks here are really just a short summary or a survey of the literature that's been written, a lot of it by the central bank economists, but also academic economists. And I'm going to focus in my remarks on the so-called retail CBDCs, that is the digital currency deposits that would be available to households and firms. And I'm not going to really...
CBDCs, central bank distributed or digital currencies, right? These are the plugs that will be put into RippleNet to enable instant, virtually free cross-border transactions, right? Fantastic. All right, keep going, Charles. You're killing it, boss.
Discuss the possible benefits of these accounts and speeding settlement of transactions. And instead, I'm going to focus on the investment characteristics of CBDCs. So, in particular, the central bank digital currencies offer an opportunity for investors to hold another form of a safe and liquid asset. And so what do I mean by a safe asset? Well, that's an asset that has low default risk, that has relatively stable value, and an asset for which there's very little private information so that the buyer of the asset can be confident that he is not getting cheated. A liquid asset is an asset that can be used sometimes to make transactions, or at least it can be used as collateral, and it's an asset that has a deep market so that it can be sold easily even during times of turbulence. And so I think we can say that safe assets are liquid and that all liquid assets have the characteristic of being safe.
So what is that saying? That really, for a currency to be safe, it just needs to be liquid, right? And it doesn't just need to be liquid, right? We'll go back here, so we'll play back the last little bit here. But it doesn't just need to be liquid, it needs to be safe, and safe is low risk of default, low relatively stable value, and that there is little to no private information on the value of an asset, right? So XRP and most digital assets meet these tickers, right? As far as safe, as far as liquid, we're invested as XRP investors in number 3. And even though it's not number 1 yet, number 3 is working with the individuals who have the money to be able to finance them to become number 1, right? So let's re-listen to this last little bit and we'll jump into the next slide.
Safe and liquid asset. And so what do I mean by a safe asset? Well, that's an asset that has low default risk, that has relatively stable value, and an asset for which there's very little private information so that the buyer of the asset can be confident that he is not getting cheated. A liquid asset is an asset that can be used sometimes to make transactions, or at least it can be used as collateral, and it's an asset that has a deep market so that it can be sold easily even during times of turbulence. And so I think we can say that safe assets are liquid and that all liquid assets have the characteristic of being safe. Now, it's generally viewed that for a well-behaved government that those assets are safe and liquid. And I want to categorize the liabilities of the government, and here I mean the consolidated balance sheet of the government, including the central bank balance sheet, and begin then by listing some of the properties of these different liabilities and how central bank digital currency would differ from these other government liabilities, but all of which I presume have some aspect of safety and liquidity relative to privately issued assets. So currency is is a very liquid asset, but it's also a cumbersome asset for making transactions, and it's very cumbersome as a store of value. I mean, that's why we've been able to drive interest rates below zero in some cases. Currencies don't pay interest, and on the other hand, they can be used easily in transactions, and importantly, they maintain anonymity. Now, reserves, and I'm talking about here reserves held at the central bank by private banks, are, of course, very liquid, and they pay interest, but their drawback is that they're only available to banks. Bonds, government bonds, are considered to be liquid and safe, but not as liquid as currency or deposit accounts. They do pay interest.
So what did everybody who is at least a little bit knowledgeable of cryptocurrencies catch here, right? That XRP, at least XRP and many others, they are still technically paying interest, but that interest is not in the form of money made out, value made out of nothingness. It's value that has been made as a result of our fiat currencies inflating far faster than these digital currencies, most of which, the older ones especially, their rate of inflation is slowing, right? Bitcoin's rate of inflation is halved every year, or every 2 years. So it will just become more and more scarce compared to the traditional financial system until suddenly it's so scarce that compared to the dollar, it's so little is created compared to the dollar or a traditional system that you're going to just watch it forever just pull away until it liquidates, entirely the fiat system. That's why, at least why I believe that the ultimate conclusion of this digital market is the complete and utter cannibalization of the traditional financial system, and thus with it, our traditional way of life as nationally oriented individuals, right? We're going to reorganize ourselves, I think, in the coming decades. I don't know how. I don't know what that will look like. I hope it will be largely peaceful, but there's a very good chance that it won't. But for now, let's just focus on the fact that our crypto here is that he is basically laying the platform essentially for how digital assets are going to fit into the current system, and how currency reserves and bonds have traditionally been viewed as different things, and how crypto, this blockchain technology can represent all three indivisibly. Like there can be a network dedicated to each of these that's specifically focused on that, or that can incorporate the features of multiples, right? But let's let Charles talk about that for us.
So where does a central bank digital currency come in? Well, they could take two forms, and I'm not going to spend much time here on the token-based CBDCs. These, you could think of these as sort of a digital Bitcoin or a central bank Bitcoin. And so one possible advantage of a token-based CBDC is that it can maintain anonymity. It could be designed that way. It doesn't have to be designed that way. And indeed, I mean, it seems unlikely to me that there are many central banks that would want to issue yet another asset that allows anonymous transactions. I mean, many central bankers feel there's already too much of that going on. The other drawbacks of the token is that it's difficult to arrange how to pay interest on a token, and then some of the studies have discussed the possible difficulties of maintaining parity of a token with the physical currency. So I'm going to set those aside and mostly now focus on CBDCs that are a claim to an account at the central bank. And we can think of those, you know, they're sometimes called reserves for all. And the idea is that the public, the households and businesses would have access to accounts much like reserves. They would be, of course, liquid. They possibly could pay interest. They're a less cumbersome asset than cash, and they can be used in transactions, but they would not be anonymous. So one of the main rationales, I would say, for creating such an account is to give the private sector access to an asset that has the same safety and liquidity characteristics as reserves, which otherwise is not currently available to the general public.
So essentially what he is saying is it is the ability for you to them to implement this system that would allow them to utilize a underlying blockchain interledger system that all these central bank digital currencies would connect up to, and those would then facilitate what he just discussed, which is the ability for these currencies to then be utilized up front, while also allowing them to offer interest rates on top of these, essentially making just, you know, crypto fiats. And these crypto fiats will ultimately have the same fate as, you know, traditional fiats, in my opinion. You know, that's just my opinion. I think that, you know, to attempt to repeat the same thing over again is insanity, and fiat is an experiment that has failed every time that's been implemented. So, you know, if history repeats itself, or at least rhymes, right? But enough tangent. Back to the CBDCs, right?
So you know, what are the competitors? What is available to the public? Well, you know, the privately issued assets, for example, deposits held at banks, are an obvious alternative. And as many of the studies have pointed out, and don't take offense when I say this, but the private sector may be better at creating new products and may be more efficient and less bureaucratic than central banks. And so they may have an advantage over central banks in that regard. But they have the problem that they are not generally considered, deposits at a private bank are not generally considered as safe as deposits that would be held at a central bank. Now, there are insured deposits, and so they have the backing of the central bank, but there are limits on deposit insurance, and besides which deposit insurance has its own drawbacks as a means of providing safety, because then they create moral hazard on the part of the private banks because the depositors have less incentive to monitor the behavior of the private bank. Now, another possibility that's been floated is starting narrow banks. So narrow banks are banks that would take in deposits and invest them entirely in reserves, and that way depositors would, would have an additional degree of safety. I mean, they're still not as safe, I would say, as an actual central bank deposit, because you still don't know exactly what the owner of the narrow bank is up to. But they have a lot of the same characteristics. But there is one drawback that I'm going to mention in a few minutes. And then there's the hybrid accounts, which are basically accounts that would be established at current banks, but would be somehow segregated, and these accounts would be backed 100% by deposits, reserve deposits held at the central bank.
What kind of reserve deposits? And what kind of reserve deposits that facilitate this kind of interconnectivity? What is this reserve deposit they're talking about? Is there anybody in the private sector who could offer a central bank reserve, aka liquidity, right? Is there anybody out there that's working with the banks? Oh! I remember. Do you remember? I don't have to say it. Let's continue.
So those would have a lot of the same characteristics as a narrow banking proposal. So first of all, what's motivated this interest in central bank digital currencies? Well, I think a lot of it was motivated from the fear that the central bank currencies were going to be replaced by digital currencies. Now, my own opinion is that fear is unfounded, or at least it's premature, because digital currencies, first of all, have not been very useful for making transactions. As we know, the value of the digital currencies has fluctuated pretty wildly. And in any case, digital currencies still really don't replace a central bank currency, because they don't function as a unit of account. Goods and services are priced in central bank currencies. We have dollar prices or euro prices of goods. We don't have, if you go to the store, there are no goods that are priced in Bitcoin. So if you're a Bitcoin holder, you're still, in a sense, taking on foreign exchange risk if you want to then use your currency to buy goods and services.
So let's rewind just slightly here for this, right? So keep in mind his use of terminology. He said that he's trying to reassure all of these banks that, don't worry, these central bank distributed currencies are absolutely going to protect you for at least the medium term, right? That's why he said that the fear in these systems displacing banks is unfounded, or at least premature, is him saying, if we take this path where we join before it's too late, then we can elongate our time here in this space as this housing agency that we all represent, and we can enjoy profits, enjoy retirement based off of our engagement with this system as opposed to rejecting it. And by the way, I can't wait to introduce you to somebody on our panel, but that's for later. First,
to buy goods and services. So what are the benefits then of a central bank digital currency? Well, as I said, it gives the non-bank sector access to a safe and liquid asset with the same characteristics of reserves. It's been argued that in some countries it's going to improve access to the financial sector. For governments, it may be a less expensive way to finance debt because you can pay a lower interest rate on CBDCs than on short-term debt because of their liquidity properties. And in essence, it may be that a country that issues a CBDC can capture some of the exorbitant privilege that the U.S. enjoys. The U.S. has enjoyed the ability to issue debt at a very low interest.
All right, so I have to pause right there keep in mind what this man just essentially said. He said, okay, so, these CBDCs, they're a great option for controlling debt. What debt? The global debt that's ballooning out of friggin' control that everybody's freaking out about. Calmly freaking out about, calmly. But they're freaking out about it. And rightly so. They're all sweating bullets. They're looking as quickly as they can for a solution. And oh, look, there's Brad Garlinghouse. Oh, Brad, save us? Can you save us? I think this guy's going to save us, so you guys should listen to him. He'll talk afterwards. Don't worry. Legitimately. Wait till we get into this conference, you guys. People missed so much subtle stuff that I'm so happy to be able to bring to you. Anyways, I'm forgetting things that I wanted to touch on because I'm so excited about the stuff that is being presented here, right? Yeah, so the exorbitant privilege. He's saying that, listen, you can dump your debt into this CBDC, which sources its liquidity from a global liquidity solution, which we know to be XRP, right? We just know that that's what RippleNet is. It's a global liquidity provider, and the CBDC is how they're going to inject liquidity into that network. And this is how it's going to be done. And so all the times that you're sitting there listening to all this fear, FOMO, FUD, whatever, FUD, this fear, uncertainty, and doubt regarding how private and central banks are issuing CBDCs, and these are going to somehow kill XRP. No, this is the future. This is exactly what Ripple Labs wants. Why do you think Brad Garlinghouse is sitting on stage with this panel discussing, or sitting there while they're discussing this, right? The CBDC. He's a proponent for it. He wants it to happen because he knows that's how you get inflows into XRP, right? So let's let him continue and see what else we can get out of this. I am going to go for at least another 6 minutes, so let's see what we can get here.
Interest rate, because U.S. Treasury bills are considered to be safe and liquid, so possibly other countries, by issuing a CBDC, could capture some of that exorbitant privilege. Now, there have been concerns about CBDCs, and some of them, I think, are a little bit overemphasized. So one thing is that if the private sector has access to a CBDC that pays interest, then commercial banks would have to pay a higher interest rate in order to attract deposits. That, in turn, may lead to higher interest rates charged to businesses for loans or to households for home loans. But I think all of that is a little bit overblown, because the central bank could always offer a low enough rate on CBDCs to keep market interest rates low. It's also been argued that CBDCs could cut into bank profits. Some have argued, well, that's a good thing, that it's monopoly profits. But in any event, I think that is also something maybe that central banks could control by, in effect, subsidizing the private banking sector by offering higher rates of return on reserves. Now, if the CBDC was issued as a zero interest rate deposit, it's been argued that would put a hard zero lower bound on the effective lower bound. Now, central banks can set interest rates a little bit below zero because of the cumbersomeness of holding large amounts of currency. But if there were zero interest central bank digital currencies, then it would be difficult or really impossible to push the interest rate below zero. But the main concern that's been raised about CBDCs is what would happen in a financial crisis. So it's been argued that there would be a run to safety to the central bank digital currency. Now, there have been counter-arguments to that. One is that central banks could lower the interest rate, possibly well below zero, although I think politically it would be difficult for central banks to be offering the public accounts with very negative interest rates. Alternatively, during a time of financial crisis, the central bank could simply limit inflows to the CBDCs, Or, alternatively, if money is flowing into the CBDC, that could be recycled to the private banking sector through the discount window or other forms of loans. So it's been argued that that's not a conclusive argument against CBDCs. Now, here I would mention that this is an issue if the narrow bank takes the role of issuing these safe assets, because the narrow bank, privately owned narrow bank, doesn't have the same incentive for the stability of the financial system that central banks do. And I think this is kind of a major drawback to the narrow bank proposal.
The narrow bank proposal that he is referring and stepping around very carefully is JP Morgan coin. Just so that we're clear, it's the private institution that doesn't have the central banking institution's best interest at heart, and so the central banks of the world are very keen on maintaining their world dominance and not allowing any private contenders to jeopardize that, right? There is a power struggle that occurs within these systems. Individuals at Ripple have actually been publicly vocal about this in videos in the past. I could potentially dig those up for anybody if they're interested. But let's finish up, see if we can finish up his panel here, and we'll call this good episode, right?
Finally, I would say that another issue is if it were the U.S. dollar that was took the form of a CBDC, that I think there would be concern in the rest of the world that relies on dollar funding, because I think that the Fed would not necessarily have the financial health of other countries' banks in mind, and so they may be less active in protecting other banks during banks in other countries during a financial crisis. So let me conclude. Should a central bank create a CBDC? And I think it's up in the air. I would mention that I think that there will be an early mover advantage, that whoever first offers one would attract a lot of deposits from the world. They would have sort of their own exorbitant privilege, but being the first mover, they would also incur a lot of risks from the unknown aspects of the CBDC. And I'll stop here. So our first panelist is Tobias Adrian, who is the financial counselor and the director of the Monetary and Capital Markets Department of the IMF.
And the reason that I allowed him to announce Tobias is because Tobias is the man, and we're going to talk about Tobias in our next part of this series. I hope you've enjoyed this breakdown. I hope I've managed to simplify things down to manageable terms for anybody that finds all this financial economic jargon to be just a bit too much to handle when they're barraging you with it, right? Also, if anybody feels that my interpretations were inaccurate in any ways, please clarify how I construed a false opinion. Don't just like say some, oh, you lied here, you lied or whatever. Please explain what I said wrong and what you believe is correct, so that we can have a dialogue about it, right? But otherwise, I don't expect any trolls or flames, because I haven't gotten really anything. I think I've gotten 1 or 2 negative comments, and that was on a controversial video that I have since amended for. So I hope to see all of you in my next video. This has been Jade Martian, and once again, if you've enjoyed my content, please hit that like, smash that subscribe, and ring that bell so that you can be up to date with all content that I release. So I hope to see you on Mars.